Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 22, titled An Alternative to Rolling Up in the Same Contract Month, the Mid-Contract Unwind Exit Strategy. Now, when we write a covered call, our main concern is the price of the stock dropping below our break-even. For example, if we bought a stock at 48 and sold the 50 call for $1.50, our break-even is $46.50. So we're in a profit position until the stock reaches and dips below that $46.50 break-even. And of course, that's where we have our exit strategy arsenal to deal with that situation. But what if the price of the stock goes in the other direction? It moves up exponentially. Is there an exit strategy opportunity when that happens? Because after all, if the strike moves deep in the money, we have maximized our return at that point in time. We generated our option premium plus any share appreciation from current market value up to the strike price had we sold an out of the money strike. So let's take a look at the considerations when we have a scenario where the strike moves deep in the money. Well, some might say, let's roll up in the same contract month, buy back the short call and sell another one at a higher strike price. Now that will be most likely at a debit situation. But when we factor in the amount that the stock price will go up in value by removing that initial call obligation, it may work out to our benefit. However, there could be some profit taken. If the price of the stock moved up a lot from contract beginning until the middle of the contract or whenever this occurs, we have concerns about profit taking. So even though we're at an unrealized maximum return at that point in time, rolling up may not make sense, or at least there is some risk involved. Another alternative is what I call the mid-contract unwind exit strategy, which we use early to mid-contract when the strike moves deep in the money as a result of share price moving up significantly. Now, in this particular case with the MCU exit strategy, we unwind our entire position. In other words, we buy back the short call that we originally sold and execute a new covered call trade with a different stock with the same expiration. So we're generating a second income stream in the same month with the same cash investment. Now, a lot of this depends on the time value cost to close the original position. Not the total cost to close, but the time value cost to close. And we're going to get involved with a real life example in just a moment. The third possibility is we could just take no action and wait as expiration approaches and then reevaluate our situation. We may want to roll the option. At that point in time, the strike might have moved out of the money. So we could wait until contract expiration. So really, my favorite would be the mid-contract unwind exit strategy if, in fact, the time value cost to close makes the calculations sensible to take that type of action. So let's have a look at a real-life trade made with Telemetry, Inc., which trades on the NASDAQ exchange under the ticker symbol BEAT. Now, on November 12th, the stock was trading at $62.25. The $60 in-the-money call option was sold at $5. So we got a premium of $5, which consisted of both intrinsic value and time value, and we'll break that down in an upcoming slide. Now look what happened about 16 days later. BEAT was trading at $68.85. So we sold an in-the-money call initially to give us additional downside protection, but in fact the stock went the other way. It went up to $68.85, leaving that strike, the $60 strike, deep in the money. Now, the cost to close that $60 strike was $9.50. That seems like a heck of a lot of money to spend to close that option. But look at it this way. At the time that we were considering buying back the option, the most that beat can be worth to us because of the contract obligation would be $60, the strike price of the option we sold. That is our contract obligation. However, if we bought back that option for $9.50, share price would move up to $68.85, the current trading value of the stock, because we no longer have a contract obligation. So we're plus $8.85 on the stock side, and we're minus $9.50 on the option side. And if we rolled up, we could sell the 70 call at $2.50. So you could see we would be in a net positive position at that point in time, right? We're plus $8.85 minus $9.50. So that's 65 cents on the negative side, but with $2.50 on the positive side when we resell that option. However, we still have concern about profit taking after the price of the stock went up substantially early in the contract. So let's have a look at the initial calculations, which we could feed into the Ellman Calculator, the multiple tab, and these are 12-day returns. Initially, it was a 5-week return, but at that point in time, it was a 12-day return if we closed that position. So with B trading at 62.25, we sold the 60 in the money strike at $5, and that resulted in a ROE, or return on our option, of 4.6%. Now, even for a 5-week return, that would annualize out to 46%. For a 12-day return, it's way, way higher. I'm referring to the annualized return. Now, there is no upside potential because we sold an in-the-money call, so we have an obligation to sell at a lower price than current market value. However, there's downside protection of 3.6% because of the intrinsic value of the option premium. So that means we're guaranteed a 4.6% return as long as share value does not decline by more than 3.6% by contract expiration. So we're in a pretty good position here. We do have an unrealized maximum return of 4.6% at that point in time. Now, how much is it going to cost us to close that position? Once again, it's not important the total premium. What is important is the time value cost to close, because the intrinsic value component of the premium is going to be neutralized by the increase in share value by removing that contract obligation. So if we go to the Unwind Now tab of the elite version of the Ellman Calculator, it will tell us, putting in all the information, that the time value cost to close is $65 per contract. Remember, it was 65 cents, so it's $65 per contract. That represents a 1.08% time value cost to close. The question we ask ourselves, can we generate 1% more than that by closing our position mid-contract? If the answer is yes, then it's worth doing. I say the answer is yes. So that would be the position I would take. So where do we stand after closing the short call? If you remember, our initial time value return was 4.6%. The time value cost to close is 1.1%, meaning that we're plus 3.5% at that point in time. Now, rolling up has the risk of profit taking, so let's assume for a moment that we will not roll up in the same contract month. Now, we could sell B and use the cash generated from that sale to purchase a new stock with a different covered call trade. And there our goal would be to be getting at least a 2% return for the rest of the contract month. We figure that all out ahead of time. And if the answer is yes, we could get it with a different stock in a new covered call trade of 2.1% or higher, then we'll go ahead and execute the mid-contract unwind exit strategy. If possible at that point in time, see if you can get that time value of 2.1% with an in-the-money strike, so we're protecting the gains that we had on that position at that point in time. So let's look at an overview of this. When a strike moves deep in the money, there is an exit strategy opportunity created, and we should take advantage of it. We're blue-collar investors. We take advantage of every opportunity that comes by. Rolling up in the same contract month can create a net credit, but there is the risk of profit taking. So I tend not to want to roll up in the same contract month with traditional covered call writing. That may be a strategy I would consider with the poor man's covered call. Now, the mid-contract unwind exit strategy depends on the time value cost to close. And that's why we use the Unwind Now tab of the elite version of the Ellman Calculator to get that time value cost to close. We would implement this strategy in the first half of a contract month where we can generate about 1% or more higher than the time value cost to close, in this case, higher than 1.08%. Now, I know many of you already have the basic Ellman Calculator, but for those of you who don't, you can access it for free on our website, www.thebluecollarinvestor.com. Just click on the free resources link on the top black bar of all the web pages. To get additional information on mastering the strategy of covered call writing, go to our BCI store, and we have the complete encyclopedia for covered call writing. You're going to want to read the classic edition first and then volume 2. We also have a recently updated covered call writing online streaming DVD program with downloadable workbook. There are also some advanced covered call writing books, many other tools and calculators in the BCI store. So ladies and gentlemen, there you have it, BCI podcast number 22, an alternative to rolling up in the same contract month using the mid-contract unwind exit strategy. I want to thank you all for taking the time to watch this video. I hope you enjoyed it, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.